What's going on, guys? Welcome back to another video. Today we're going to be going over how to trade options on Robinhood. Some of you have requested this video, and it is for beginners who are getting started with options. So we will be going over how to buy, call, and put options and what the differences are and how we make money on them. So first, you want to go into your settings on the investing tab to enable options. So you go to settings, investing, and then we scroll down until we see options trading. So in this section, this is where we will be enabling options. And as we can see, I have options trading enabled. So after you do that, you should be able to get access to options. So we can go ahead and take a look at an example of the options chain. For this example, we will be using Apple. So you go into the stock, the ticker, and then over here you will see an option that says trade Apple options. So you want to click this and it will bring up the options chain. And right now we can see we are on buy calls, and then we can also buy puts. For this video, we're just going to be buying calls and puts. We won't be going into advanced option strategies, which is where we will be selling calls and puts, but we will be buying these options on Robinhood. So when you buy a call, you are purchasing a contract for the right to buy 100 shares at a given strike price by a certain expiration date. So that's the main things we want to look out for: the strike price and the expiration date. And so when you buy one of these contracts, it's going to be a lot cheaper than owning shares. So as we can see here, if we are at the $122 strike calls expiring next week, March 12th, we will have to pay $212 because the price you see here is for 100 shares, as we mentioned earlier. So how this works is if Apple stays above $122 by expiration, which is March 12th, we will be given the right to buy 100 shares at $122. And options are a way to exponentially grow your gains, but you could also lose a lot of money because it's basically leveraged returns. So you make a lot of money if the stock just goes up a few bucks because we are multiplying our returns by 100. And so what a put is the right to sell 100 shares by a certain expiration. Same deal. Let's choose another strike price, 120. For buying this contract, we will have to pay $181 premium. So puts are the opposite. You make money when the stock goes down, and calls, you make money when the stock goes up. So puts, if the price of Apple goes below or stays below $120 at expiration, which is March 12th again, then we will have the right to sell 100 shares at $120. So this means if Apple, say, goes all the way to $110, we still get to sell our shares at $120 because that's our chosen strike price. So this is basically a quick overview of calls and puts, how to enable them on your account, and how exactly you trade them. They are very risky, but if you are new to options trading, it doesn't hurt to buy a contract or two just to test it out. But just keep in mind, buying calls is bullish and buying puts is bearish. And you can make some pretty good returns if the stock price goes in your predicted direction. That's about it for this video. If there's anything you guys want me to clear up, please leave a comment down below. If you are new here to the channel, please consider subscribing and leaving a like on this video. Thanks.